It's been an interesting few weeks full of economic news, which has led to a lot of uncertainty about the future of our economy and our property markets. Now, if you're a regular listener to the show, you'd know that once a month I catch up with leading economic commentator Pete Wargent for these, what we call big picture podcasts, when we look at the macro factors affecting our economy and our property markets. And boy, have we got a lot to discuss today. If you asked me at the beginning of this year, I wouldn't have thought that we'd be talking about inflation reaching 8%, interest rates at 30-year highs, or a war overseas that keeps raging, or floods back home that are creating havoc. However, all these factors influence what's happening to our economy back here and our property markets. So today I'm going to have a chat with leading analyst Pete Wargent about all these economic challenges and what's ahead for our property markets. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Boy, has a lot happened since I last spoke with Pete Wargent for our monthly Big Picture podcasts. In recent weeks, we've had a federal budget, a housing accord that promised 1 million new homes, rising inflation, rising interest rates, and everyone who could get media attention throwing their hat in the ring, predicting what's going to happen to property values. Now, while regular listeners will know Pete well, if you're new to this podcast, well, firstly, welcome, because I can see that there's thousands of new listeners every month. But the reason I'm keen to discuss these matters with Pete is not because of his academic credentials as a chartered accountant, chartered secretary, or because he's got a financial planning diploma, but I enjoy my chats with Pete each month because of the credible perspective he brings on what's happening around the world with his background as an international investor and business person. So, welcome, Pete.
Thanks, Michael. I always look forward to the Big Picture podcast.
Well, lots has happened in the last month since our last Big Picture podcast. Almost don't know where to start with all the discussions. And while the media is continuously barraging us with negative messages, worries about inflation, interest rates, what's happening overseas, a recession coming here, it seems that in many ways the marketplace is almost getting used to that. And I know you recently wrote a great blog about the concept that at least people in the housing market are past peak fear. They're actually just getting on with their lives.
I think so. I mean, if you look at most of the fundamentals for the economy and the housing market, they're the strongest we've seen in years and years. We've got full employment, lowest unemployment rate in half a century. We've got immigration starting to ramp back up to record highs, so record demand for housing. I guess there's one thing that's been pulling in the other direction, which has been inflation, which is, I guess, the cost of all the lockdowns and stopping the global economy for a couple of years. There's always a price to pay. There's no free lunches in economics. And it's the interest rates movements that have really been making people panic a little bit, not least because we've got a whole generation of people in the housing market who've never seen interest rates going up like this. It's a very sharp rate of increase that we've seen. But I think people have realised that the world keeps turning. Asking rents are up, 25% over the year. So the demand is very strong for housing. I think people are also starting to sense that we're getting closer to the top of the interest rate cycle if we're not quite there yet.
I think you're right. So people have decided they've got to get on with their life. They think that inflation is going to peak later this year. Interest rates are getting close to the end. Now, there's two elements to it too. Consumer confidence is very low because of the continual negative messages in the media. But spending, retail spending, is still very high. So while we may be cautious about buying a new home or investing large amounts of money, it seems like we're more than happy to spend on ourselves, Pete, especially for food.
Up until very recently, yeah. I mean, on the day of recording, we've actually just got the latest figures for Q3, and it's just starting to roll over. You have to remember the Reserve Bank didn't start hiking interest rates in earnest until May. So you wouldn't expect to see retail slow down until those hikes have started to flow through. Now, here we are in November, and it's already in the third quarter, retail volumes were flat. Prices were up a bit, obviously, with inflation. But things like household goods and food retailing and other retailing just starting to roll over now. So, and that's a natural response to, firstly, higher prices, and secondly, the rising cost of money. But that's what monetary policy is supposed to do. And some of the other drivers of inflation, for example, in the construction sector as well, just starting to roll over. So that's what will help to start bringing inflation down next year.
That's great. So if we just talk about the housing markets, as we started to say, in general, it looks like on the ground, people are starting to get on with their lives again. And that's been showing in Dr. Andrew Wilson's latest data, which showed asking prices held steady for both houses and units in October. And similarly, SQM Research, Louis Christopher's figures confirmed the same, that vendors are not dropping their prices as they're bringing their properties onto the market. Now, that's what we call a leading indicator. And in 2-3 months' time, those property sales data will be reported. And even though the sale prices will be a bit less than asking price, they always are. In fact, if asking prices remain steady, it looks like end values down the track will remain steady as well. So we haven't found a floor yet, and there will still be a few months of reported data of dropping property values, but the market's looking for a floor. Just like auction clearance rates, that's another good indication that more people are prepared to pay what the going rate is.
Yeah, so borrowing capacities have obviously taken quite a knock, certainly from the heady peaks of sort of August, September 2021. And in some cases, borrowing capacity is down quite significantly, maybe 20 or 30% for some borrowers. So that sort of makes a difference at the margin of what's happening in the market, has an impact. We often talk about some of the factors which could cause a property crash, things like very high unemployment or very high interest rates. And we haven't got those factors. I think one of the things you often talk about is, well, if there's a big oversupply of housing, like we saw in Spain or Ireland, back in the financial crisis, well, that could cause problems. But we don't really have that issue in this cycle. In fact, it's the opposite problem, really, is that we're going to have a big shortage of housing over the years ahead and over the next decade. And in terms of supply actually on the market, well, we're going into the spring selling season. In fact, we're already into November and there's been no surge in listings. In fact, a lot of people are just sitting it out because there's a job for everybody who wants one. And most people are thinking, well, it's not the environment to sell into. And that in itself is actually underpinning the market a little bit.
Well, what you were hinting at was that there are a number of factors that could cause a property market to crash, as opposed to the steady downward trend we're getting at the moment, which is the normal cyclical downward trend. And those factors just aren't there. Huge oversupply, people not being able to keep up their mortgages, people being unemployed, a major recession or depression, a minor recession like we may have a technical recession, and I'm not sure that we will. Well, we had one 2 years ago, Pete, and I don't think many people felt it. Technically, we did have 2 periods of negative GDP and life went on.
Yeah, I think in Australia's case, that we'll have a slowdown next year in terms of headline GDP, but actually with the rate of immigration picking up very rapidly, it would be very hard for Australia to have a recession if we're starting to see population growth heading back to 350 or 400,000 per annum. You'd be really struggling to go backwards in that kind of an environment. Never say never, but I think the US is more likely to have a recession and the Eurozone. I think Australia is relatively better placed. We will have a slowdown though, and that's actually what the economy probably needs because it's been overheating of late.
Well, the US is getting rising interest rates. So people here are saying, hey, we've got to do the same. If US just increased interest rates 0.75%, the Reserve Bank is undercooking things. But they don't necessarily realise that the mortgage rates are different there. A lot of people in America have got fixed rate mortgages for 25 and 30 years, while in Australia, more people are on variable loans, which means we feel, mortgage holders in particular, feel the increases of interest rates much faster than the US. They need to raise rates higher there to get the same effect.
Yeah, it's interesting. I went to the cricket the other day with Dr. Chris Caton, who is the chief economist at BT Financial, and he was previously a Westpac economist. And Chris came to Australia in 1958, and he was saying that once upon a time, there was a period when if the US raised interest rates, Australia did the same, and it was quite mechanical. The trend of interest rates makes a difference, but we don't have to follow in lockstep. So In the US, the federal funds rate may well get to 5% early next year. That's going to be very painful for the housing market in the US, especially with the funds rate going from 0 to 5 so quickly. I think in Australia, we don't have to follow to the same degree. As you mentioned, most borrowers in Australia are on variable rate mortgages, unlike the US, or short-term fixed rate mortgages of 1 or 2 years. A few hikes actually has a bigger impact on confidence here. So that's one reason. The counter argument is that if the US interest rate goes up much more quickly than it does in Australia, that actually brings the Aussie dollar down and we could import some inflation that way. But don't forget, Australia doesn't only trade in US dollars and with the US. Actually, we import an awful lot from China these days. And if you look on a trade weighted basis, well, actually, that index hasn't really gone anywhere. So I think the imported inflation argument is a bit of a furphy, to use some Aussie slang. In terms of where the cash rate gets to, there's a lot of debate. I think the Reserve Bank will hike in December, which will take the cash rate target to just above 3%. Some people think it could go much, even to 4%, but I think we'll probably find that inflation peaks in Q4. In fact, I'm almost certain it will. We may get another hike next year, but we're pretty close to the top now, I think.
Well, the Reserve Bank has slowed down. It's pausing. It's assessing the impact of the near-decade high levels of interest rate on the broader economy, on inflation in particular, and we know there's a lag there. So even though there's monthly inflation data coming out now, interestingly, there wasn't much discussion about it in October, was there? They really worked on the quarterly data, which was backward-looking. So it's going to be interesting to see. They are going to have to raise it a bit more to lower inflation. And nobody's certain. When you look at the various bank economists, Gareth Aird from Commonwealth Bank suggests there's only going to be one more interest rate rise, while others are suggesting 2 or 3.
Yes, and I think you only have to look at what people were predicting a year ago. Actually, market pricing was more accurate than all of the economists combined, I think. So there's always uncertainty. And I think the inflation figures in Q3 and Q4 will be quite painful, partly related to flooding. The Ukraine war has spiked the prices of some goods. But I think you can start to see in all the real-time figures that actually even the interest rate hikes delivered to date are really starting to have an impact on things like construction. Now we're seeing retail volumes, consumer confidence. So that is what monetary policy is supposed to do, and it is working. I think we'll start to see the tenor of the commentary change relatively soon.
One of the things that people are talking about is the fixed rate mortgage cliff that now looms large for next year. Now, we remember that there was a whole lot of cliffs that we didn't fall off during the COVID. There was the fiscal cliff, and when they got rid of JobKeeper, and the interest rate cliffs that they talked about. I'm not sure what's going to happen, and I'm reasonably confident that our banking industry is going to cope. But I think it is important to understand that a lot of people did take out 2 and sometimes 3-year fixed rate mortgages at those very low rates a couple of years ago, and they are going to come out of those to variable rates that are going to be much higher. And Pete, many of them are going to be locked into the same banks. They're not going to be able to swap, because currently, if you're going to take new loans, if you're going to change banks, they've got that 3% buffer on top of the current rate that banks have to assess you at. So people are in some sort of mortgage prison.
Yes, I mean, if you look historically in Australia, usually about only 1/5 of mortgage balances were accounted for by fixed rate mortgages. The vast bulk of them have been on variable rate mortgages over the years. But then we had 6 consecutive quarters through the pandemic, from the September 2020 quarter to the quarter ended December 2021, where we saw extraordinary levels of fixed rate borrowing. And it did make sense. We saw fixed rate mortgages, in some cases, under 2%, unprecedented stuff. So it made sense for those borrowers at the time. I don't think what anybody foresaw, though, was that we could see the cash rate target getting back to 3% so quickly. So that 3 percentage points buffer that you mentioned, which was an important regulatory tool in October 2021, well, that's been effectively used up this year. Now, if you think the most common tenor of fixed rate mortgage in Australia is 2 years, well, you can see that those 2-year mortgages are now starting to roll off. And in some cases, people are going on to 6% mortgage rates. That's really going to hurt. Now, can the banking system cope? Well, yes, it can. We saw through the COVID lockdowns that actually the banking system can cope with even extreme shocks. There are levers that can be pulled. I think some borrowers will look at going on to interest-only terms because we don't have much interest-only lending at all in Australia now compared to what used to be the case. I think in some extreme cases, mortgage holidays could be used. But actually the easiest safety release valve to be pulled, as you mentioned, is to get rid of the 3 percentage points buffer that was introduced because the interest rates were at zero, and just bring it back to the normal range. And that will allow people to shop around, take some of the pressure off and get a better deal. So we're looking to the regulator to step in there and recognise that the extraordinary circumstances of zero interest rates are no longer with us.
Well, I think that the regulators are going to have to look at a couple of factors, including encouraging property investors to get in the market rather than charging them more, because we're just not building enough properties for our population growth. And I know there's that 1 million new home aspirational target in the budget I'd like to talk about in a moment, but let's talk about the need first, demand, before we look at supply, because as you mentioned a short while ago, it's estimated that our population is going to increase by 3 million people. Currently, our population is around 26 million people, but it's likely that it's going to get to 29 million rather than the 30 million they initially thought by 2030. Those 3 million people are going to, well, they're not bringing homes with them. Some of them are natural population growth, others are those coming from overseas. And then there's also the huge rebound in temporary visa holders. We just are going to get a much faster population growth than have been projected for a while, Pete.
Yeah, so we already knew that the new Labor government has increased the permanent migration cap to 195,000 per annum. You mentioned we've actually got this massive rebound in temporary visa holders, so things like international students, and then we'll have working holiday makers. Tourism hasn't really rebounded yet. I mean, it's double what it was at the start of the year, but it's still got a long way to go to get back to normal. I think if you factor in all of that, well, look, the budget papers predict net overseas migration of 235,000 per annum year after year after year into the future. But we do know that historically we've tended to underestimate population growth in Australia. You already mentioned the natural growth in the population. So there's been a rebound in the fertility rate. So we'll get another 150,000 anyway, just because births will be exceeding deaths. And I think the big thing here is 3 million extra people by the end of 2030 or thereabouts. The vast bulk of new arrivals into Australia are renters. I know this is somebody who migrated myself many years ago. You don't go to a new country and buy a home on day one. It just doesn't happen. So international students, skilled migrants, the permanent migrants coming back to Australia, the rental demand is going to be enormous over the rest of this decade. We're just not, at the moment, providing the rental housing. Asking rents are going up 20, 25% per annum at the moment. This will bring investors back, but is it enough?
Now, it'll be interesting to see where these skilled migrants go, because if you look at it, these skilled jobs are going to be in the large part in the healthcare, in the aged care, in those sort of industries. So when people talk about skilled migrants, often they think of highly skilled, skill level 1 or 2 jobs, but in fact that's not the case, because we're producing the IT jobs and most of the doctors here. You're not going to import doctors from overseas. So a lot of these people are going to move into their suburbs. Then these skilled migrants aren't the sort that are going to be working necessarily in the CBD. In fact, if you think about it, 80% of the jobs in Australia are in the suburbs. Just go down your main street and you'll see there's the shops and there's the kindergartens and there's the schools. So that's going to create a huge demand for accommodation in our already pretty squashy suburbs. We know there's a dire shortage of properties around Australia at the moment, and the government's come up with this aspirational target. The federal government in the budget said we're going to build 1 million new dwellings in the next 5 years. Oh, it's actually not in 5 years' time. We're going to start in 2 years' time. Wonder why they're doing that, because that's just going to keep giving us this negative shortfall. But the government's only locked itself in for 10,000 homes and another 10,000 social housing, affordable housing homes. So what do you think of this interesting initiative?
Well, every good budget needs a headline. You remember years ago, the coalition promising 1 million new jobs in 5 years. But that would only actually account for the population growth. So it's a big number and it gets a headline, but it doesn't really mean a lot. And this is very similar in many ways. 1 million new homes to be built between 2024 and 2029. Well, that's really the bare minimum that we will need to build. And in fact, if you go back to a decade earlier, 2014 to 2019, we built more than that, nearly 1.1 million. So it's not really a very ambitious target. It's just a big number that can go in a headline. As you mentioned, the federal government's providing some funding, 350 million. But, over 5 years, that's a tiny amount, 10,000 affordable dwellings. I think it was interesting the Treasurer mentioned that the market will need to deliver the vast bulk of this new housing. Population growth, as we know, going to be massive over the remainder of the decade and beyond. So there's not much policy detail in terms of how this is going to happen. Yes, they're going to look at how they can speed up land release, and it's a very constipated approval system in Australia. But yeah, there's not really 200,000 dwellings per annum. Don't forget we demolish 25,000 a year anyway, and this is just going to be the bare minimum. So at the moment, there's capacity constraints in the industry. Construction is actually contracting, so we're not building enough already. So we're already behind the curve, and population growth is ramping up very rapidly.
And all the new construction is going to cost a lot more. So if they're wanting to put them in the locations where the demand is, which is what the housing accord was about, it's going to be very difficult to find land there. And then they're saying, okay, as you correctly said, it's actually got to be private funding that's going to happen, cause this, and that'll be a combination. Well, they're talking particularly of institutional investment, but I think they're going to have to also encourage mum and dad's property investors like you and me, because traditionally institutionally funded housing hasn't really been a large part of Australian housing stock. Now we're talking about build to rent, but for institutions to actually put their money into this rather than where they can get more money, because most institutions aren't going to accept the 3% gross yield that mums and dad investors are prepared to accept. The government's probably going to have to subsidise it with tax incentives or other things. So in many ways, it's just another form of public housing, Pete.
Yes, I mean, the Treasurer said that the government will look for, I quote, innovative ways to generate strong returns or strong enough returns for institutional investors. It's a real paradox here, though. You can either have strong returns from housing or you can have affordable housing. You can't have both. At the moment, the returns aren't there for institutions. Typically, capital growth, you would think, on build-to-rent style of property. In real terms, there isn't going to be any. We've seen lots of build-to-rent in London over recent years, and it's been very mixed in terms of its success. And I think as well, you often talk about sort of big numbers being bandied around. You'll remember 5 years ago, Jacinda Ardern campaigning on the Kiwi Build scheme to deliver 100,000 homes in New Zealand. Well, so far, 1,366 at the last count. And in fact, they've demolished more than have been built. So, yeah, look, the government is not great typically at delivering additional homes. They're going to have a look at the institutional sector. But the reality is, as Chalmers said, the vast bulk of new housing will have to be delivered by the market. And as we know, in Australia, there's limited greenfield land available. We've got a shortage of trade, shortage of materials, capacity constraints. It's going to be a massive challenge.
And as you mentioned a while ago, it's the challenge of getting development approvals as well. Red tape, green tape, blue tape. I'm not sure exactly what they call it now. But it's also the NIMBYs, not in my backyard, and the notes not over there either, that's going to make it hard to have development in some of the areas where a lot of people want to live. I guess putting all this together, while there are headwinds and there are challenges ahead, in the medium to long term, there's lots of good going to happen to our property markets, which are going to be stabilised by an increase in population growth and generally an economy where everyone who wants a job's got a job, going to slowly be getting more wages. So no property crash ahead, in my opinion, Pete.
It doesn't look that way. I mean, you just need to look at the declining number of listings, the extremely rapid rise in rents. We've got the lowest vacancy rates on record. We've got unemployment at 50-year lows. So yes, we're in a downturn at the moment. I think the big thing that everybody's watching is when is the inflation rate going to peak? Well, we're recording in November. Inflation will actually probably peak around now. It won't get reported until the new year. And then it will start to ease next year. Because if you look at the things that have actually driven inflation and therefore interest rates, well, it's been energy prices from the Ukraine war. But we've actually had 2 rounds of severe flooding in Australia, which really haven't helped on food prices. But those tend to be temporary spikes. Construction is already contracting. So construction's been a massive driver of inflation. Well, that's going to drop away. Fuel prices, those are going to drop away, at least in terms of the contribution to inflation. So Australia's inflation rate has been higher this year than was expected because of things like flooding, the Ukraine war, but it will start to roll over in time, and therefore the Reserve Bank may have a couple more hikes to go, but we're getting pretty close to the top, and that's what everybody in the housing market is watching.
Well, it's interesting. We record these big picture podcasts once a month. Who would have thought a year ago we would be talking about inflation at the rate we are, about interest rates having this shock and awe package of double interest rate increases and one after the other for 7 months? Who would have thought we'd be talking about a war on the other side of the world that lasted since February, and all the floods? Hey, I thought we had global warming, and yet we're flooding all around Australia. It'll be interesting to see what we talk about over the next year in these monthly big picture podcasts. Thanks for your time, Pete.
Always a pleasure. Thanks, Michael.
Before I share my mindset message with you, and following on from my discussion with Pete, I guess we are in for some interesting, challenging times, and the media is not going to stop delivering negative messages. It'll be a while before that happens. The media loves teasing us and making us click onto their website. But as I hope you understood from my discussion with Pete, the market seems to be changing. As we said, we're over peak fear, and people are now taking advantage of this window of opportunity to get set for the next stage of the property cycle. So here's a question to you. Are you doing everything possible to take advantage of this opportunity? Why not have a chat with my team at Metropole to see what is available for you? We'd love to put together a strategic property plan for you, because it's important in this stage of the cycle to plan your next steps. You can't just go out on gut feel and do what you think is right, because most properties are not going to increase in value. We're going to have a period of flat growth, but there are some areas that are going to outperform. So why not take advantage of the frameworks that I've put together? I've fine-tuned over 5 decades, and my team have been helping Australian property investors with for over 20 years. We're going to help you safely generate wealth that you can pass on to future generations. Go to metropole.com.au and find out about our range of services, including strategic property advice, buyer's agency, especially if you want to buy a home, strategic wealth advice with Ken Race, property management, property development, renovations. We've got lots of different services. I don't know what you need, but I do genuinely believe that we can, well, I was going to say level the playing field, but no, I think we can actually stack the odds in your favour. So go to metropole.com.au and find out how we could work together to help you safely generate substantial wealth that you can pass on to future generations.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Are you an optimist or a pessimist? Now, this is a really important question to consider in this week's mindset message, because pessimism is a recipe for failure. Now, I've often mentioned it in these sessions before that optimists are more successful in life, but there's science behind what I'm saying. A paper published by the University of Cologne in Germany in May 2015 said, well, they actually studied 68,000 Americans and Europeans, and they found that pessimism causes poverty. The study noted that pessimism makes you wary of trusting others. And I can follow that. It went on to argue that when you see people in a pessimistic light, untrustworthy, self-interested and deceitful, you're less willing to rely on others. Those in the study who are the most pessimistic, interestingly, actually not surprised, surprisingly, also happen to be the poorest. If you're wary of trusting others, you're likely to have lower income now and in the future, the study concluded. Conversely, those in the study who were optimistic and had a more trusting view of others had a higher income than the pessimists. You see, pessimists miss out on opportunities because they're less likely to ask for help and less likely to collaborate with others. I've just realised that no one succeeds on their own. I've written about this often. I've podcasted about this before too. You need a team of people around you. You need others who believe in your cause in order to succeed. It's virtually impossible to succeed on your own. The most successful self-made millionaires have dedicated a team of people around them. Think of Richard Branson or Elon Musk. Interestingly, they also happen to be the most optimistic people to work for. Their unbridled optimism infected everyone around them like a virus. So if you're a pessimist, you're literally sabotaging your life. You're pushing the very people you need away, and you're left with no choice but to rely on yourself. So my message in today's mindset moment is pessimism is a recipe for failure. If you are thinking pessimistically, you probably don't even realise it. Remember, we're all driving around with one foot on the accelerator, doing good things, and one on the brake. We've all got good habits, rich habits, and we've also all got some poor habits. So watch out the way you're thinking. And are you a glass half full or a glass half empty person? If you want to be successful in any area of your life, you've got to become optimistic, not pessimistic. We're living in interesting times, aren't we? But twice a week I'll be back with the Michael Yardney podcast to help give you some clarity and direction. But if you've got some benefit from this, please help somebody else understand what's ahead. On every podcast app where you're listening to this, there's a share button. On iTunes, there's a couple of buttons down the bottom if you just press it and share it with somebody, or just tell somebody about the Michael Yardney podcast, or why not tell the world by leaving a review? I'd really, really appreciate that. Now, I'll be back again real soon, but you can catch me on social media. Just look for Michael Yardney. And why not subscribe to my YouTube channel so you can get the regular weekly Property Insider chats with Andrew Wilson. Just look for Michael Yardney on YouTube or propertyinsiders.info. You can also join my private Facebook group. There's lots of places to find me. The Facebook group is Property Update Private Facebook Group. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?